So this video is trying to explain what happens in the land and buildings account and the provision for depreciation account when we do revaluation. So this is question 7 on revaluation. So land and buildings account, we'll have to do this for a number of years and provision for depreciation again for a number of years. So each year what we'll do is land and buildings will start off with the balance brought down. This is how much our land and buildings are worth from the previous year. And at the end of this year we'll have a balance that we'll carry forward to the following year. There's only two things really that we can think of on the debit side of land and buildings. So did we revalue? That increases the value of our land and buildings. Did we spend money buying new buildings or getting new buildings built? That also increased land and buildings. And we ask ourselves, did we dispose of anything? If we didn't dispose or buy and there was no revaluation, well, the balance BD for 1 year becomes the balance CD, which then gets brought forward to next year. Okay. So every year land and buildings ask ourselves, did we revalue, did we buy, or did we dispose? Provision for depreciation. We have a balance brought down, which is all the depreciation on all the years up to this year. So all the expense that I've written off on it over many years, and I put all that together into a liability account, provision for depreciation. At the end of this year, we will depreciate. So we will work out the expense for depreciation for this year. And then there's two other questions we have to ask ourselves. Is there a revaluation happened during this year? If we did revalue, then we'll have to cancel the depreciation at the time of the revaluation and transfer that to a revaluation reserve. Was there disposal? If we disposed of a vehicle or land and buildings, then we'll need to take that out of provision for depreciation to work out what the land and buildings were worth, and did we make a profit when we sold it, or did we sell it for less than it was worth? So every year we'll have to do that. Okay. So for provision, we'll have to work out depreciation expense, which will be added on to original balance, and then we ask ourselves, was there a revaluation, was there a disposal? Okay. So that's the basis of what we're trying to do each year. So this is the question that we are dealing with here now. I'll just quickly go through it. So it starts off, this here is year 1, okay. 1st January 1990, bought property, so it consisted of land and buildings. So the land, it says, is worth 200 and the buildings is worth 400. Depreciate the buildings at 1%, straight line method. So the depreciation, we would have had this up to 2000, because we're asked to do this question, we're asked to do the accounts for the years 2000 to 2004. So at the beginning of 2000, we had 600,000 in our balance for land and buildings, which is the original building that we got. We haven't revalued, we haven't bought anything new or sold any buildings. Our provision for depreciation down the bottom here, well, our balance in the provision is 400,000. So that is the 400,000 that the business is worth, or the buildings are worth, multiplied by 1%, multiplied by 10 years. Okay. And I'll just squeeze that out there. Okay. So then we say what happened during 2000. We valued the property 850. Of this, 350 was land. So now my land has gone up to 350 and my building has gone up to 500. Okay. It says that the revaluation 350 was land, so therefore 500 must be building. So I've separated those and just marked those there. So and that happened during the first year. So the revaluation reserve, we started off with a balance of 600. We need to increase that up to 850. I need to have a closing balance at the end of the year of 850. So I need 250 added on, so debit, land and buildings, because it's an asset, added on to increase the value of our land and building, and it brings it up to a new balance we'll carry over to next year of 850. Okay. So all the way through this year, because you revalued at the beginning of the year, okay, it used to be worth 600 before the revaluation, but all through this year it was worth a new figure of 850, okay, and of that 850, 350 is land, so the 500,000 has to be depreciated. So when I go to do my depreciation expense, I'll have 5,000, so that 5,000 is 500 multiplied by 1%, multiplied by 1 year, because it is just for this year. Okay. Now, what happened then during the next year? So 2001, But we started off with a balance of 850 it brought over from the previous year, and it said we sold for 450. Well, now what we sold it for is not relevant yet. We'll deal with that in the disposal account, which is where we'll work out did we make a profit or loss when we sold it. Now, we sold the land which cost 200 but since revalued on the 1st of January. So this land originally was worth 200, we revalued up to 350. So I'm going to take that 350 out of my land and buildings account, put it into my disposal account. I'll mix it then with the 450 I got for it to work out did I make a profit or loss when I sold my land. So I start off at 850, which is land and building. Now I'm getting rid of the land, so all I'm left with is the building, which is worth 500,000. That's my balance, which I'll carry over to the following year. So that's what I'm going to have to start next year. Now, what happened then in the provision? So in the first year, I had 10 years worth of depreciation. When I revalued it, I took away that 10 years, I cancelled that 10 years of depreciation, and I moved that to the revaluation reserve, which is a liability account we'll deal with later on in a separate part to this question. So I've taken that out of the 40,000. I've cancelled all the depreciation up to the day that we revalued, and then I'll depreciate it based on its new value at the end of the year. I should have made a mistake there. That should be 500,000, not 400,000. So I depreciated 500,000 times 1% for a year, so that's 5 grand. So that then gives me my balance CD of 5,000 depreciation, which is carried over the following year. Now we are going to depreciate at the end of this year, but we ask ourselves first, did we dispose or revalue of anything? Well, we did sell something for land, but land is not depreciated, so there's zero taken out of the provision for depreciation because we never depreciated the land in the first place. So we're going to add in another year's depreciation, which will be another 500,000 times 1% times 1 year. Okay, so that depreciation is going to be added on. So now I've got a total of 10 grand in my provision for depreciation account. So that 10 grand then will be carried over when I start doing my depreciation for the next year, which is the third year, 2002. Back up to my land and buildings. So I started 2002 with 500,000, the one building I had from before. I bought a new building for 200, so I got a bank figure of 200. 80 grand was paid to contractor for extension, so I've got another 80 grand. Both of those are just called bank because I wrote checks. Now I think in class I may have actually put those two together, but that's grand. I'm putting we're not giving a date for this, so I'm just going to put the date at the beginning of the year. It doesn't really make any difference, but so I've got that, and then I also have, it says 10 grand was of wages was used in this. So that means that the expense that we have on our profit and loss called wages is too high because not all of that expense was used to make profit. Some of it was used to make a building. So I take that out of wages, I'll reduce my wages expense, and I'm going to increase the value of my land and buildings by the work that those guys did. So that means my new building is worth 290, and my old building is listed on paper as worth 500,000, less its depreciation. So my balance at the end of the year, I've got 790,000 then, the two buildings added together, 500 and 290, so I have a balance of 790, which is the value of my buildings. Go down to my provision for depreciation. I started off 2002 with 10,000, which is the depreciation that we had carried over from the previous year, which is basically 2 years depreciation on building 1. Now I have to depreciate building 1 and building 2. Now building 1 is going to be depreciated the same as it was before, so 1% of 500,000, which is 5,000, plus the new building. Well, the new building, okay, just quickly check how much the new building cost us. 200 plus 80 plus 10, so it cost me a total of 290. So on my depreciation then for that is going to be, it's 290 is what the building is worth, so it'll be 290 times 10% is 2,900. Oh, sorry, times 1%, sorry, it's 2,900. So that's where I get the figure of 7,900. Another way of doing it is I could go up here and say my balance BD at the beginning, or sorry, at the beginning of 2003, which is the same as the end of 2002, is 790. 10% of 790 is 7,900. Okay, so now we've got 2002 finished. We have a balance now of 17,900 in our revaluation, sorry, in our provision for depreciation account, okay, which is all of our depreciation carried over into 2003. So let's look and see what happened in 2003. So our revalued buildings owned at 869, 10% increase. So when I revalue, I cancel all the depreciation up to the date that it happened. Revaluation happened the 1st of the 1st 2003. So on the 1st of the 1st 2003, revaluation was 17.9. I'm cancelling all the depreciation I've written off up to the date, the 1st of the 1st, which is basically this balance date. So I cancel all of that, and that's transferred to a valuation reserve. Then we'll go back to land and buildings, and it says revalued buildings at 869. So that means the buildings were worth 790. I'm adding on 10%. That's what it says there. So 10% increase in respect to the buildings, each building. So I'm adding on 10% of 790 onto it. So I get a new balance of 869, which becomes the balance brought down for the start of 2004. Now let's just think of those two buildings again. Those two buildings were worth 500 and 290, but now we've added 10% value onto both of them. So now that's worth 550, and this is worth 290 plus 10% of 290, which is 29. So that's where I get the figure of 319. Add those two together, and that gives us the figure that we're given the question of 869. Okay, so let's move on. We've dealt with that one, so we move on to the last year, which is, I think, a little bit tricky. So the buildings purchased on the 1st of the 1st was sold for 800, so that's one building, and the remaining buildings were revalued. So two things happened. We have a disposal of a building, okay, and we have a revaluation of the building. So up here, my buildings started at 869 at the beginning of the year, after they were revalued the previous year. We dispose of building one. So this is the building that we'd originally bought way back. It was included in the balance of 600 at the beginning, and that building was revalued twice. It was revalued, let's just quickly check. So this is building number one. It was originally worth 200 at the beginning, and then we revalued it here up to 350, sorry, up to 500, and then we added another 10% on to increase that then up by 10% to 550. So that building we're going to get rid of. Okay, so the building, so it says buildings purchased was sold for 800. So again, the amount we get is not relevant at this stage. We'll deal with that in the disposal. So I'm taking out what that building that I just got rid of was worth on paper to me at that time. So at the time I got rid of it, it was worth on paper 550 less any depreciation is written off on it. So I'm taking that out of the land and buildings account. Then I go to my provision for depreciation account, and I'll need to take out all the depreciation on that building since we revalued. And we revalued at the beginning of 03. So before I dispose of it, and disposal happens at the beginning of 04, so that means I've written off 1 year's depreciation on this building worth 550. So when I go to do my disposal down here, let's just quickly check. So now I'm onto this. So there's two numbers here that I've deliberately left unfinished. Okay. Disposal is going to be all the depreciation on the thing that I got rid of. So the thing I got rid of is worth 550, so 550,000, and I multiplied that by 0.1, so it's 1%, and I had it at the new value, at the recent revalued figure of 1 year. So that means there's, oh, that's the wrong maths. I think I've got an extra zero in there. 50, oh, it's 0.01, that's where my mistake is. Okay, so the building that I got rid of is worth 550,000, and oh, no, still mistaken that 0.01. So that building that I got rid of, it was revalued the previous year to 550,000. So it would only have 1 year's depreciation at 1% taken away on that building. So I'm taking that out of the 8,690 balance that I had in my provision for depreciation account, and then the figure that's left is that building is going to be revalued. So whatever is left after that's taken out, whatever is left is going to be cancelled. So when I had original balance of 869, take away from that the 550, so that 3190 is the depreciation on the building that's left. So all I have left now, remember, is 2 building, or building number 2, okay, which originally was worth, going back up here to the notes I've put up here, it was originally worth 319. I've decided to revalue it, and now that building is worth 900 when I've done my revaluation. So that 2 building now, its new figure is new, and that 900 becomes relevant for my depreciation. But it originally was worth 319,000, so 3190 is the 1 year's depreciation on that since I previously valued it. So then I go and depreciate it. I've taken that out, so I've basically cancelled all of my balance BD, some of it because I got rid of one of the buildings, and the other building I've revalued, so I'm cancelling the depreciation on that and transferring that to the revaluation reserve. So then I have my depreciation expense for that year. So depreciation expense is that building was worth 900,000 multiplied by 1%, so that's 9,000. So when I go to do my balance of that account, I'll add up 2 sides. So the balance then is going to be 17,690 minus the 2 figures there. Okay, so my balance CD is 9,000, which I'm going to bring forward and start off the next year with. And we have a balance BD on the debit side of 9,000 in land and buildings. I know it's complex, but you need to have a listen to this video again so that you can work out what is happening at each stage.